What we're going to do now is make the transition from actual journalizing to posting to the ledger. Remember, you journalize first your transactions into the journal, and then you post them into the ledger. We're halfway through the transaction analysis. That's why I purposely stopped at 5, because I want to connect the dots to the actual transference of journalizing to posting. All right? So, this is in your journal. Now we're going to post. So each one of these accounts that have been affected, if we went into the actual T account, if we went into, if we went into the actual T account, they would have several different accounts with their own T accounts, right? So we would have cash, and I'm just writing them out as I see them, guys. No particular order. Common stock. Land. Supplies. Accounts payable. We already have cash, so no duplicates. Service revenue. And accounts receivable. Can we see accounts receivable over there? Let's see, where are we? So you can't see supplies. So what I'll do is put supplies right here. And what are we missing? We have service revenue, we have accounts receivable. So that's 1, 2, 3, 4, 5, 6, 7. And we're missing accounts receivable. All right, so those are all of our accounts in our quote-unquote ledger, okay? And so how do we post? Very easy, guys. We see that cash was debited for $30,000, so we write $30,000 on the debit side, piece of cake. We see that common stock was credited for $30,000, so we write $30,000 on the credit side, piece of cake. We see that land was debited for $20,000, so we post $20,000 for land. Okay? We see that cash is credited for $20,000, so we credit $20,000 for cash. Hopefully you guys can see this. Let's see. Let's help y'all out right there. Okay? We see that cash was, we did that already. We see that supplies was debited for $500. We saw that accounts payable was credited for $500. We saw that cash was debited for $5,500. We see that service revenue was credited for $5,500. We also see that accounts receivable was debited for $3,000. And service revenue was credited for $3,000 as well. And so this is all you have to do with posting. You have these transactions that was journalized, and you take that information and transfer it directly into your ledger. And this is how this information will look. So to back up, give you a bird's eye view of where we are. So far we have journalized the following transactions and post those transactions into our ledger. All right. So what we're going to do now is move on. So now we're on transaction number 6. And Transaction number 6 tells us that we're going to pay $2,000 for rent. Suppose that we pay $2,000 for rent. Keyword, paid. Paid always means what? Cash is doing what? Going down. Anytime you see the word paid, you always make cash go down. If you have to make cash go down or you have to decrease cash, you always do what to cash? Debit or credit cash when you're decreasing cash? Well, cash is a part of the R system and it needs to decrease by credit. So anytime you see the word paid, always credit cash. Piece of cake. You see word paid, credit cash. So we paid rent. Rent is a what to the company? Expense. Expenses are part of your your all group. And so expenses are going up. How do we know expenses are going up? Because we have more expenses now that they happened. So expenses are going to go up. So we're going to debit rent expense. And we're going to credit what? Cash. Because the key word is paid. Paid, always credit cash. Next it says that suppose we paid on an account. Wow, it's back to back. Paid on an account. Go straight to it. You see the word paid, you know you have to do what? Credit cash. Credit cash. So we can credit cash right now. You're halfway home. You have a check, half the answer. Right? $300. Even though we debit first, I just went ahead and credited cash because I saw the keyword paid. So now all I have to do is know I have to debit something. At any given day, if you guys haven't realized, when you journalize, your debits always equal your credits. It's all about balance. So what are we going to debit since we paid on an account? Well, we have 2 accounts we have to think about, accounts payable or accounts receivable. Keyword, paid on an account. Which one you think we're dealing with? Accounts payable. Accounts payable is a liability. And is it going up or down? Think about it. You go to Macy's. You go pay on your account on Macy's. What just happened to your Macy's bill account since you made a payment? It should do what? Go down. How do you decrease liabilities? By a debit. So we're going to debit accounts payable. For $300, and we're going to credit cash. For $300. Next. Suppose that we collect on an account. Suppose we collect $2,000 on an account. How do we journalize that? Collecting $2,000 on an account. Keyword, account and collect. When we're talking about account, we need to do account receivable, account payable. Keyword, collect and account. Obviously, we're dealing with accounts receivable. Account receivable is an asset. Now, we collected the cash on the account. So what should the actual account do since we collected cash on it? They already set it up. We already set it up saying that these guys owed us in the future a while back. But now they're paying on that account. So what should that account receivable do? Go down. So our account receivable has to go down. And how do you decrease assets? By credit. So what are we going to debit? Because we have to debit something. What did we receive? Cash. So we debit cash, credit accounts receivable. For $5,000. Why 5,000? Anyway, let's say $1,000. $1,000. Let's say $1,000. This textbook have a little hiccups every now and then. Let's say $1,000. Okay? Number 9. Suppose that we paid a cash dividend of $5,000. We paid a dividend of $5,000. What's the key words? Paid dividends, right? Paid dividends. Every time you see the word paid, you always what? Credit cash. So what are we going to debit? Logically, you wouldn't even have to think because you know you have to debit something. What was the other key word? Dividends. So logically, you would debit dividends. But theoretically, why is dividends being debited? Because dividends is a part of what group? The all, the clear. All. Why? Dividends is also known as a what? Withdrawal. So how do you increase a dividends? We had more dividends given out. So how do you increase the dividends? You debit it. So we're going to debit dividends and credit cash for $5,000. Easy breezy if you're doing what you're supposed to do. We're going to skip transaction 10. Yet another hiccup from the publishers. We're not going to talk about that yet. We're going to say that suppose that we pay cash for salaries. Say we pay $1,000 cash for salaries. Okay, so what are the key words? Paid, obviously credit cash, right? And salaries. What is salaries to the company? Salaries is a what? Well, it happens based on day-to-day operations. It's an expense. Very good. So how do you increase expenses? We paid on the salaries, but they actually happened. So how do we increase the expenses? We debit salary expense and we credit cash. Even though you pay on an expense, you always increase expenses. Why? Because we record them because they happen. Whenever an expense happens, even though you paid on it, you have to increase it. Why? Because that expense has to be recorded because it happened. If you pay on a liability, the liability must go down. Okay? How much was the salaries? I don't know, let's say another $1,000. Okay? And so now we're going to do the posting.